Breaking down today's turnaround in the markets, we have Joe Bell, Schaeffer's investment research senior equity analyst. He's warning of more volatility in the market, but he's basically a bull in this market. And Alan Knuckman in the pits of the CME. Alan, I want to start with you and talk about a quick recovery. This is a V-like recovery that we've had here, isn't it, after January?
Yeah, it's absolutely epic. We've seen this before, so we got to remember now, if you take this measured move, the distance of this sell-off, add it onto these highs, once again, 1950 is the target in the S&P, so we still got about 7% more on the upside. The Nasdaq's already completed that V recovery, so, you know, who says how much higher that we can go from here, but things still look very supportive. And it's not just equities today. The way they came back was very impressive. But it was also a lot of these other markets. We're looking at gold, we're looking at oil, we're looking at bonds. They're seeing a lot of asset reflation as people feel a lot better than they did last week.
But do you call reflation with natural gas? Listen, I don't tend to want to focus too much on commodities here, but this is a major jump of 8% on top of it. You brought up the metals. We have silver continuing to move up nearly a full percent.
Right, you've got to remember the metals have been absolutely beaten down, and we're so far out of favor, this bounce is only natural. Natural gas, obviously, is very much affected by the weather. I'm from the Upper Peninsula of Michigan, where you get 300 inches of snow, so this is just winter to me. This is not a big deal. But natural gas was at $2 a couple years ago. It was, you know, if you look at the midpoint for the last 10 years, the midpoint's probably about $7 or so. So we're not even to that midpoint. It just feels like pain because we were at such historic low levels.
Well, if you're from the Upper Peninsula of Michigan, this must be like summer to you. But, Joe, I want to go and talk about the general mood of the market, because January we seem to have a move. There was no good news that could move the market positive. It seems that we're out of that. Is it premature to say that?
You were exactly right. When you looked at January, the price action was weak. We had the pretty strong sell-off, and there was a lot of panic and a lot of fear out there. But when you actually looked within the context of the market, it was actually only about a 6% pullback. Kind of reminded me of a lot of the pullbacks in 2013. We saw active managers cut their exposure by nearly half. We saw short interest still near multi-year highs. Sentiment polls, extremely pessimistic readings. A lot of panic and fear for just a 6% pullback. And once again, it proved to be a nice buying opportunity as that panic selling sort of oversold that rally, and perhaps it was a good buying opportunity.
We want to do the right thing for our viewer investors. And needless to say, there has been many a panicked individual over the past year and a half who's been wrong, stayed out of the market, lost money. However, at some point, are we not going to see a larger correction than just 5%?
That at some point, yes, we're going to have corrections of 10%. Historically, at least the past year and a half or so, they've been around that 5 to 7% range. Really what we look at is expectations. What is the general sentiment around that pullback? When we saw the 6% pullback, we saw that extreme amount of fear. That told us that perhaps there is some upside there. Now, if we go ahead and get like a 5 or 6% pullback, and then all of a sudden everybody's not expecting that larger correction, that would be when perhaps we would expect perhaps lower prices, because not as many people are bracing for that downside.
But Alan Knuckman, the earnings so far have been very mixed. I mean, we have had everything from positives to Whole Foods going down today, by the way, about 7% based on their earnings report yesterday. So with a mixed earnings report, is it really conceivable that we could sort of go in an upward trajectory like we did in 2013?
It's very possible. The earnings are what it's all about. I think that's what people need to be reminded of, that how well corporations are doing. If you look at them as a whole, we're doing better on the top line, and most importantly, better on the bottom line for the first time in a long time. So I think that puts the focus on how well corporations are doing. But to get back to your guest's point, it's about leverage. You've got to find stocks that have good levels to lean on. Home Depot leaning on this 72 level. Looking at McDonald's. McDonald's has went from 84, which was a low in 2012, to 104, which was a high in 2013. So the midpoint's 94. We're right at 95. So it's about being at levels where you don't have to risk a whole lot if you're wrong, as opposed to buying a stock that's already had a big extended move. Then you're in a lot of danger, obviously.
Okay, Joe, we want to get people some stock picks right now. You like AK Steel. You also like Expedia. You've got a soft spot on your heart for ITB Home Builders, which is the Home Builders ETF. Let me just pin you down on AK Steel. Big commodity move here. Why?
Yeah, steel has an extreme amount of doubt. When you look at all the sectors within the entire U.S. stock market, steel has the highest amount of sell ratings when you talk about analysts. So analysts are the most bearish on steel, and yet the price action has been incredibly strong the past few months. You look at AK Steel trading near some support, had a strong earnings report just a couple weeks ago. So improving fundamentals, strong price action. We still think expectations are extremely low. We think steel in general could have a lot of upside in 2014.
Joe Bell, terrific having you here. Thanks very much. Alan Knuckman, we're going to check in with you in a couple of minutes for the S&P futures close. Thanks.